Well, hello. Here we are again, another midweek tax help. Sorry we didn't come to you last week to give you any tips and tricks of the trade. We were busy getting our clients prepared and ready for that first filing day because, as you know, the IRS started accepting and processing returns on February 12th, which was last Friday. I believe that was Lincoln's birthday. A lot of people had the day off, so they may not have been paying attention. But just so you know, IRS is open and accepting and processing tax returns. So we want to get everybody ready for that first day. So we missed last week's midweek tax help. So here we are today. I'm Latoya Tillett, owner of Tax Plus Financial Services. And so what I wanted to talk to you guys about today, just a second. I wanted to kind of talk to you guys a little bit about whether itemized deductions are right for you. A lot of people know what they are and a lot of people don't know what they are. So just to give you a short explanation, is an itemized deduction is anything that can reduce your taxable income amount. So that's like your medical expenses, that would be property taxes, interest you pay on your mortgage, charitable contributions, whether cash or items donated. You know, you can even donate cars, different things like that. So those are kind of what you would see, and also your state taxes as well. That's what you'll see as an itemized deduction. And so a lot of people get confused because they wonder why they can't take all of these deductions. Well, it's because with the new tax code that was implemented a few years back, you have a higher standard deduction and they took away the individual exemptions. So with the higher deduction, you're pretty much, if you don't have any write-offs that are more than your standard deduction, then it necessarily won't count, just to be honest. I know a lot of people will probably say that's not the best way to put it or a technical term, but in all honesty, it doesn't count if it's not more than what your standard deduction is. So for instance, if you're single, your standard deduction for this year, 2020, well, I know it's 2021, but I'm saying for tax year 2020 is $12,400. So if you don't have anything, like if your mortgage interest and your property taxes and your medical bills and dental bills, vision bills, if they're not more than $12,400, it's not going to really benefit you. Same thing for married people. Your standard deduction is 24,800. Head of household, your standard deduction is 18,650. So if you don't have anything that you could write off that will be more than those amounts, it's gonna, most tax softwares or tax professionals are going to revert you back to the standard deduction. So just so you know. So how to know if itemized deductions are right for you? So for medical, for instance, that's usually one of the highest expenses most people have. So, if you go to a lot of specialists and, it only, let's say your medical insurance only covers so much because we are required to have health insurance as well. When during the Obama administration, that came into play where you have to have at least a minimum coverage of health insurance. So a lot of times the health insurance, you pay your premiums and you pay co-pays, or let's say you have to get hospitalized though, and you have a deductible. Most of those you have to pay up to the deductible amount. So let's say your deductible is $3,000. So you foot the bill for the $3,000 before the insurance kicks in. Some insurances are higher, some have lower deductibles. It's just a broad spectrum. I'm not pinpointing anything in particular, just giving you some roundabout numbers. So just kind of think about it like that. So if you had something major or you had to go see some specialist and you ended up spending more than 7.5% of your adjusted gross income on your medical expenses, then anything over that 7.5% is tax deductible. And so sometimes I see clients, that have different things going on. They have medical equipment that they have to buy. All of those things can be considered tax deductions if it falls in the category of being more than your standard deduction. And so you just don't want it to only be medical bills. Let's get that clear too. So if you're able to write off any medical bills, or even if you don't have medical to write off, if you have your property taxes and your mortgage insurance to write off, you can do that as well. So some people may have purchased a home. So that means if they purchased a home during 2020, they can write off all of the mortgage interest that they paid until December 31st of 2020. from whatever time they purchased the home until the end of 2020. And they also will get a chance to write off their property taxes as well. And when you purchase a new home, because I do real estate, so I know these things. When you purchase a new home, normally you're purchasing it at a higher price than what the tax assessor assesses it at, and they'll give you something called supplemental taxes. And so when you combine all those property taxes together for your first year of purchasing your home, you may be in a position to where you're exceeding your standard deduction, especially if you're single. That could be well over $12,000. Paying out in mortgage interest, depending on the price of the home, how much your interest rate is, different things like that. So just take all of those into account. So that's pretty much in a nutshell how you know if itemized deductions are right for you. If you're doing your taxes yourself, if you're using like a TurboTax or a Tax Act, or what are some of the other ones out there? Whichever other ones out there that you guys use when you try to file your own taxes. Sometimes they'll give you the option in there to put in those expenses, and make sure you have backup for these things too, because the IRS does kind of look a little harder at people who file Schedule A's, especially if they have a ton of write-offs, like, let's say it's like 30, 40,000. They're definitely going to look at your tax return. So make sure you have backup for anything that you decide to write off. Get that out there. And so, where was I? So yes, you want to definitely make sure you have backup for any write-offs that you have, and then you want to kind of add those up. So if you're in the software, you could take those receipts, or you could take those expenses, calculate them by putting them in the software, and then the software will determine whether you should go itemized or whether you should go standard. And it pretty much boils down to, if it doesn't equal either more than 12,400 for single, 24,800 for married filing joint, or 18,650 for head of household. If it's not more than that, pretty much it's going to revert you back to the standard deduction. So, if you just kind of want to know ahead of time, without doing it in the software or before you go to your tax preparer, you can kind of just take your receipts and add it up. Say, hey, this is what I did this year. I donated some furniture and some clothes to Goodwill or Salvation Army, or any church, or you paid your tithes and your offering, or any charitable contribution that you made by cash to whatever organization of your choice, as long as they do hold an active 501c3 and can give you a receipt verifying that you donated that amount of money, or that amount of value in clothing or furniture or any other things that you can donate. You can go ahead and use that as a write-off. So you want to calculate all of those things and see, hey, okay, well, I added up that I donated to this organization. I donated clothes, I donated furniture, I donated some small electronics. Just kind of go through the list of everything. I had medical bills that were this much. I had to pay for glasses or dental work, whatever it is, just add it all up. And if it's not more than your standard deduction, then that more than likely you're just going to be filing with your standard deduction. If it does come up to more than your standard deduction, you definitely want to let your tax preparer know that you had items that exceeded your standard deduction, and give them the receipts for everything. Make sure you give your tax preparer the receipts for everything, because we don't want to just be pulling numbers out the sky. Okay. It's not the best practice. I mean, it can be done, or people do it, but I do not recommend it, and I do not suggest it, because you want to always make sure you're audit proof. And the way to make sure you're audit proof is by having backup for any expense and any income that you put on your tax return. So that's my little tidbit for today. I look forward to working with some of you all. I know I've gained some new clients from doing these self-help videos. So, just want to keep bringing you guys some information so you can have an idea of how to navigate your tax returns. And a lot of people still, are trying to do it themselves. So I want you guys to be informed and know that there's other options and things that you can do. But of course, if you do not have a tax preparer and you're looking for someone with solid experience and knows the deductions in and out, knows where everything needs to go on your tax return, definitely feel free to reach out to Tax Plus Financial Services, 909-494-2280, or you can check out our website, Tax Plus that's the dash in the middle, Financial Services, with an S at the end, .com, and book a free 15-minute consultation. We look forward to speaking with you soon, and happy filing season.